This is a brief review of fundamental inventory cost flow, and we're going to look at inventory cost flow in terms of retail inventory and manufacturing inventory. So let's take a look at retail inventory first. If we take a look at, we'll go right over here to inventory flow. In a retail establishment, inventory starts out with a beginning inventory. To that then we add our inventory purchases. That totals then the total goods we have available for sale during the accounting period. From that then we subtract out our cost of goods sold, and that's our cost of goods sold is basically the inventory's expense to the cost of sales during the period the inventory items were sold, and we end up with our ending inventory. Now, another way of saying this is typically what we need to do in order to compute our cost of goods sold at the end of the accounting period. We know what our beginning inventory is. We know what our total purchases are from the accounting record, so we know what the goods are available for sale is. But in order to compute cost of goods sold, what we need to do is we need to take an ending inventory of our retail space and add up the amount of inventory that's still left over. So we take the ending inventory and subtract it from the cost of goods available for sale, and that will then result in the cost of goods sold. So that's our retail inventory cost flow. Now, what I've also added here is some additional information here regarding inventory cost. Typically, inventory cost includes the following: the acquisition cost of the inventory itself, which would be net of any discounts or rebates, so inventory goes in at a net purchase price. We also add in any non-recoverable import duties. If there are handling charges, we add that into our inventory. If there's any insurance charges that result from the shipment of inventory, we add that in. We also add in, and this is very important, the freight in. In other words, the freight that was required to bring the inventory into our place of sale. And lastly, we also have any other costs that are associated with placing the inventory into usable, or if you will, saleable condition. So that's the inventory process. Again, I'll remind you, beginning inventory plus purchases equal cost of goods for sale minus cost of goods sold equals ending inventory. If we want to compute the cost of goods sold, typically we have to just switch this inventory formula around a little. We take our beginning inventory, we add in our purchases, which equal our cost of goods available for sale. We count our ending inventory at the end of the accounting period, we value it, so then we subtract out that ending inventory, which will then equal our cost of goods sold. Okay, now let's look at the fundamental inventory cost flow for a manufacturing company. And we start off with our beginning materials inventory, or in effect our beginning raw materials inventory. To that then we're going to add our net raw material purchases. And what I want to point out over here is we're using the same costing the same costing criteria that we used for our retail inventory. We're going to also use that for our net material purchases. So we have beginning materials inventory. To that we add our net material purchases. That's going to equal our materials that are available for use during the accounting period. From that then we subtract our ending materials or raw materials inventory. When we do that then, that is going to equal the materials that we actually used in our production process, in work in process. To that then we add our direct labor cost, the direct labor cost that was consumed in our production process, plus we add our overhead cost, which are the overhead costs allocated to the production process. And remember, overhead costs are those costs that we can't directly trace back to production but are essential to the production process. So we take that, and that equals the total manufacturing cost for the period. To that, then, we add our beginning work in process inventory. We subtract out the ending process work in process inventory, and that equals our cost of goods sold manufactured. So that in effect is equals all the items that have gone through and been completed in work in process. We go on, then we start out with those goods that are being transferred from work in process. Then we add in our beginning finished goods inventory. That equals our finished goods inventory, or finished goods available for sale, minus our ending finished goods inventory, equals our cost of goods sold. Okay, now let's go on to one or two questions about fundamental inventory cost flow. Question number one: how should the following costs affect a retailer's inventory? And we're given four choices in terms of increase, decrease, or no effect. So when you're ready, stop the video, and when you're done, restart it. Okay, the answer to one is A. Freight in will increase, and interest of inventory alone will have no effect. And the way we look at that, again, is we take a look at our retail or merchandise, the purchase of raw materials. That includes the price paid to the inventory, non-recoverable import duties, handling charges. But in case of freight in, we know that's going to be added to the cost of the inventory, so that will result in an increase. The thing that we don't necessarily know, so this tends to be a learning slide, but we have to remember that interest is a period cost and is not part of inventory value. So that's the answer to number one. Let's try number two. Number two, the following information is for Carl Corp for the year ended, and we're given some inventory information. And the question says the costs that should have been included in inventory for the year total how much? Again, when you're ready, stop your video. The answer to 2 is C, $515,000. And again, if we follow the costing of our retail raw materials, merchandise, the merchandise purchased is $500,000. Freight in, which is an item that we add to inventory, is $20,000. Less purchase returns, in other words, items that we've returned, that would be $5,000. So our total inventoriable cost would be $515,000. We have to remember we do not include freight out. Freight out is not a cost of bringing an inventory item to its existing condition and location. It's really a selling expense. It's a period cost, whether it's in retail or whether it's in manufacturing. And this concludes the short video on fundamental inventory cost flow.